your Prof. Zeus. For this morning, we'll discuss about capital budgeting. Shout out to all my students no, from San Beda, FEU, and of course, Arellano University. All of you can use this and can watch and learn from this video, okay, about capital budgeting. So this is the outline of our discussion. Now, number one, we'll discuss about capital budgeting. Okay. Number two, why is capital budgeting important for every businessman? We are not here. Capital budgeting is not only for accounting majors but also for businessmen, for business owners actually. And then what are the tools that we will use in evaluating projects? Okay, so here is a situation wherein the company may have a proposal or proposals, and they're evaluating which one will best benefit the company from. Okay, so what are the tools that we will use? And then we will discuss the concept of annual cash return. This is different from a bit different from your net income. And then, of course, we'll discuss the difference between between independent projects and mutually exclusive projects. Because, as I mentioned earlier, there could be, or the company could be, could have like more than one, okay, more than one project or proposals at hand. So, which one is better over the others? Okay, so we'll discuss if it's independent or mutually exclusive project, and then we'll go through an example using the Group One tools and Group Two tools. Okay. Okay, so what is capital budgeting? So capital budgeting is a process to evaluate potential major projects or investments. So I'd like to emphasize here that it is actually a tool for you to evaluate, a tool for businesses to evaluate potential major projects. Okay, so two words there: evaluate, then major projects or investments. Okay, so meaning capital budgeting is a tool that you use to evaluate major projects or investments. Okay, it is the process of analyzing investment opportunities and making long-term investment decision. So second definition is that it is a process of analyzing. So again, you're given one or two or three proposals, then you are trying to analyze which one is better than the others, okay, and how the company can benefit from it. Okay, so it's an asset evaluation, project evaluation for assets lasting more than 1 year. So we're talking of an asset that is not only for 1 year or less than 1 year, but we're talking of assets or projects that will be used by the company for a period more than 1 year. So if you would look at those definitions, keywords there are evaluate potential or major projects, and then it is used to analyze investments or potential projects, and of course, the assets or investments would last for more than 1 year. Meaning we are talking of revenue streams or benefit for long term. Okay, long term. So remember that in financial management, what we're after are to go into projects that would best benefit the shareholders. As what we said, the objective of financial managers is maximization of shareholders' wealth. So in choosing a project, one project may be better than the others. Okay, so we would like to highlight which of the proposals or project or potential investments could best benefit the company from. Okay, so say for example, the company is toying on the idea of putting up or build or buying a building. Okay, so to buy a building is the investment decision that financial managers make. Now, the second question there is, if we are going to buy a building, where do we get the cash that we will use to purchase the building? So that now becomes a financing decision. Okay, so from investing, which is buying a building, which is a capital asset, meaning you could use it for more than 1 year, to the decision of how are we going to pay the building that we will buy. Okay, because remember, if you buy the building, it will have some use to you, like it could house your office. But since we're talking of a building, some of the floors could be leased out, so therefore the company can earn rental revenue from the building. Okay, and then in terms now of raising your cash, like in this case, so how do we raise now the cash that we need in order for us to purchase the building? So that's the investment decision. Now, going to the investment decision, as you would recall from my discussion in my previous video regarding the cost of capital, okay? Now, cost of capital, that's why I introduced that first because it has a bearing on our discussion today because in terms of financing the project, the company would have to choose now whether they would go for, you know, loans, okay, or equity funds, okay, issuing shares of stock to common shareholders or preference shareholders. Now, those are the sources of funding that the company may opt to avail of in funding this investment decision. Okay. Now, I talked about I talked about in the previous video about the weighted average cost of capital. So that is also an item or term that I'd like you to have in mind when discussing this capital budgeting. Okay, so this is the whole scenario. You would like to buy an asset, a huge asset that could be used by the company for more than 1 year. So the problem is, how do you now get the cash from? Okay, the funding requirement. Okay, is the fund that you will use to finance this project, I'd say, would it earn or not? Okay, will it earn the minimum, the return that you will require from the project? Okay. Now, what are the features of capital budgeting? So first and foremost, the project here involves big amount of money. Okay, it's no joke. Say for example, purchasing a building, buying an equipment or a machine for additional production line. It's a major investment and it involves a lot of money. And so now you would realize how important capital budgeting is because one wrong decision, the company can lose a lot of money. There's a potential big return from the investment. Okay, that's why we are choosing from more, could be one or more than one. Okay, investment proposals. We're checking which will have the maximum return for the company because what we're after is to go into projects which will benefit the company the most. And of course, it involves high risk. Why high risk? First and foremost, the amount of money involved is so huge. What if the project fails? Right? What if the project will not generate the expected revenue or the expected rate of return? Okay, so there's a big risk ahead. And remember, we're not only talking of 1 year here. If say for example you purchase a building, we're talking of how many years? 20 years. Okay, so it involves high risk because as you go, further from today, then the more uncertainty it becomes. Number four, there's a long period of waiting. From the time that you initially made your cash outlay to the time that you recover it from the revenue, it takes quite a lot of time. For instance, say you purchase a building and you'd like to have it rented. How many years will it take you to really earn from that building? It may not be just 5 years or 10 years before you can actually say that you have recovered your investment. Okay, so it really there's really a long period of time of waiting. Okay, and then lastly, incremental cash flow. So you invested in a project because there's an incremental cash flow from the project or potential project. Now, why is capital budgeting important? I've already discussed with you the concept of capital budgeting. From all of those that I've discussed, you could see how important it is for businesses or businessmen to really do some capital budgeting, or you really use capital budgeting techniques before they venture into projects. Okay, and here are the three most important or why capital budgeting is important for businesses. Number one, involves high amount of investment. You know, if it's say for example purchasing a building for like 100 million or 200 million, that's a lot of money which you can actually use for your working capital requirements. So it involves not just peanuts, but involves quite a lot of money. Number two, when you make the decision to say for example purchase a building or a machine, that decision cannot be undone. Okay? Especially say you would like to construct a building. your own building, okay, rather than purchasing it. If that decision has already been made, then you have already reached the contract with your suppliers and contractors, and they've already started. That decision cannot be undone. It will now have to go through legal cases. So it's important that the company first, think about it thoroughly, because if say for example, will not the contractors will not pursue legal cases, certainly you will be made liable to pay for the damages because they've already mobilized their people. So it really, the decisions cannot be undone easily. And of course, number three, this actually is about wealth maximization. We've discussed that shareholders' wealth is the primary concern of financial management and managers. So, therefore, in choosing, one project over the others, we have to make sure that we are maximizing the wealth of the company. Okay, so those are three major importance of capital budgeting. Now, here are the tools that we use in evaluating capital investments. We can group them into two. Number one, or the group one, would be those tools that do not actually consider the time value of money. Okay? I've discussed with you before the concept of time value of money. So, group one, they do not consider the time value of money. While group two, they consider the time value of money. So, for group one, we have the payback period, accounting rate of return. For group two, we have the discounted payback, the net present value, and the profitability index. So these are the tools that we will be using or discussing this for this session. Let's have an example. AEG Corporation decided to construct a building for 10 million pesos, which is expected to be used for 5 years. The years, of course, there and the amount is they are not realistic, but just for ease in terms of computation and, of course, illustration. Majority of the floors shall be rented out to various entities, and it is expected to generate revenues of 4.5 million per year. Tax rate is 30% and the discount rate is 6%. Okay, now, so it's going to be listed out to various businesses, and they could earn 4.5 million per year from the rental revenues it will generate from the lessees. Okay, it's a tax rate of 30%. Now, what is this discount rate? The discount rate here, okay, this is actually the cost of capital. This is the cost of capital which I discussed with you in the previous video. So this is the minimum amount of return that we will require from the project, for the project to be considered for acceptance by management. Because if the project will not be able to generate at least 6%, that only means that the company will not benefit from the project at all, because the revenues is not enough to cover the cost of the capital that the company will employ. So let us discuss about the concept of annual cash return. Now remember that annual cash return is not the same as your net income. Now if you look at the table below, actually the first the first line, the first few lines are actually, or rows are actually your income statement, okay, until you reach your net income. And then from the net income that's after tax, we add back the depreciation, because remember, we are computing for the cash returns. Remember that depreciation, although decreases your income, does not require cash. So we add back the depreciation of the uh, capital asset that we will acquire. Okay, and then you have your annual cash return. So this annual cash return is the figure that we will use in our discussion for capital budgeting. Okay, now let us first go to independent and distinguish that from mutually exclusive projects. So we're talking of various options or investment proposals that the company may have. So if those are independent projects, if we accept, say, three projects on the table, if we accept project A, it doesn't mean we will reject B or C. Okay, so each project will have to be considered and evaluated independently, okay, based on their own merits. Now, when you say mutually exclusive project, if we accept A, that only means we will reject B and C. Okay, so those are that's the difference between independent projects and mutually exclusive projects. Now, going back to our example, so we said that there's a 4,500,000 revenue. Okay, let's compute this is the annual cash flow. So 4.5 million of revenue, and then depreciation. Where did we get this? This is 10 million divided by 5 years. That's 2 million pesos. So there's 2.5 million of income before tax, and 30% of this is 750. So net income after tax is 1,750,000. We added back the depreciation, so therefore our annual cash return is 3,750,000. This is the amount that we will use uh, for the tools that I have mentioned earlier. Okay, let's move on. Now, first tool for group one is the payback period. So what is payback period? When speak of payback period, this actually refers to the span of time by which the investor or the company will be able to recover its initial investment. Okay, yung cost of investment. So say for example, in a given example, the company invested 10 million or would invest 10 million pesos. How long will they be able to recover the 10 million pesos? That is the payback period. Okay. Of course, the shorter the payback period, the better the investment is. Because, say, for example, for a 5-year project, if you can recover the cost of investment on the first year, then the fourth to the fifth year will be what? Just barely, just your income. Okay. So, the shorter the payback period, as a general rule, the better the project is. Okay. Now, companies may set their own policies in deciding whether to accept a project with regard to the payback period. Okay, they may say that we will accept project if the payback period is at least at the max half of the life of the asset, because it still have half of its life for your income. So it depends on the policy of the company. They may set their own policies for that. Okay, but as a general rule, the shorter the payback period, the better the more attractive the investment is. Okay. Now, there are two types of annual cash return that we have to discuss. Number one, we have the even cash returns and the uneven. Even or uniform cash returns is what we had in our example. Okay, so the cash returns there is the same from year one to the fifth year. Okay, the annual cash return. For an even cash return, the returns or the revenues and the annual cash returns differ from year to year. Okay, will that affect the manner that we compute? The payback period and all the stuff. Yes, it will matter. Okay, so let's go to the computation of the payback period. Now, if the annual cash flow is uniform or essentially the same, so we can make use of this simple formula to compute for the payback period. Okay, that is investment divided by the annual cash return. Now, if we will go back to our information earlier, so the payback period is what? 10 million. That's the cost of the investment divided by your 3,750,000 annual cash return, or 2.67 years. So it will take the company 2.67 years to recover its initial investment, okay, of 10 million pesos. Now, is this good or bad? As I mentioned earlier, the shorter the payback period, the better. Now, the company may have its own policy of the acceptable payback period for them. So 2.67, if the company's policy is to accept, projects with payback period at the max is half of the life of the asset. We're talking of 5 years. Then this may not be accepted because it's more than half of the life of the asset. Okay, so again, it depends on the company's policy. Okay, now what if the cash flows are or the annual cash returns are not the same? So let's take a look at this example. So for instance, on the first year, the cash flow is or the revenue is 3.5 million, year 2 4.4, year 3 5 million, year 4 5.5, year 5 6.3. Now, why is this? Several factors. Number one, there could be some escalation on the rental, 5-10% increase on the rental because this is commercial. Number two, perhaps on year one, they haven't fully, the building is not yet fully occupied. Okay, they may have not reached their maximum occupancy on the first year. Okay, that's why the rental income would really go up. Okay, So therefore, how do we now will this uneven cash annual cash return affect the manner at which we compute our payback period? Okay, the answer is yes. So again, we go back to the formula that we had earlier, which is the computation of the annual cash return. So for the annual cash return, we would see here, so this is the computation. So 3.5 less depreciation, income before tax, income tax, and then add back depreciation. So 3,050,000 is the annual cash return for year 1. Year 2 is 3.6, year 3 is 4.1, year 4 is 4.4, and year 5 it's 5 million. So the annual cash return really varies from one year to the other. Now, remember, if you're computing for the payback period and the cash returns are not the same or are not uniform, okay, you cannot use the formula I've given you earlier. Okay, what you will do is you accumulate. So you accumulate the annual cash returns, okay, until it reaches 10 million. Okay, so like in this case, so that's 3,050,000 for year 1. So accumulated is 3,050,000. Year 2, there's a 3.6 million annual cash return for year 2. So 3.6 plus 3.050 is 6,730,000. So this is your accumulated annual cash return on the second year, and this is still less than your investment. Investment is 10 million pesos. Okay. Now, if you go to year 3, the annual cash return is 4.1. If you add 6.7 and 4.1, you will get 10.3 million, 10.8 million, which is now higher than the investment cost. What does it mean? So the payback period is gearing towards year 3, but not really year 3. So how do you get the exact payback period? So that's 10 million minus 6,730,000. So how much do you still need for you to be able to reach 10 million? Let's see. So that's 10 million pesos minus 6,730. Okay. So we still need is it, can you see it? Yeah, we still need 3,720,270,000. Okay. Now the year 3 is more than 3 million, more than what we need, 3,270,000. So let's get the ratio. So 3,270,000 divided by 4,100,000. So that's about 0.79. Okay, 0.79, or so we net, or let's say zero point 0.8. So therefore, your payback period is 2.8 years. Okay, 2.8 years. So it is now different from what we have computed earlier, which is 2.67. So this is a little bit longer. That's 2.7975. Why is that? Because if you would recall, our revenue for the first for from first year to fifth year is 4.5 million. Here the revenue started at 3.5. So that's why the payback period becomes a little bit longer than the first scenario. Okay, so that's how we will compute the payback period when the cash flows are not the same or even or uniform or not uniform. Okay, so therefore this is the payback period is 2.79 years. Now, what are the advantages of payback period? Number one, it's very easy to understand and of course apply. It's very It's just a simple mathematics. Okay, very easy. Even non-accounting or people with non-accounting background can easily understand what payback period is. Okay. Number two, it helps reduce the risk related to the investment because knowing your payback period, then you can easily say if the project is acceptable to you or not, right? If the payback period would consume all the life of the asset, then certainly that is not a good investment. Okay, and then of course it helps in terms of project evaluation quickly because it is very easy to understand and apply. Then you can apply it in project evaluation quickly and faster, unlike the other, capital budgeting tools, which I will discuss also, a bit complicated. Okay, we'll be using interpolations and all the stuff. Okay, so I hope you know how to interpolate. Okay, next, to payback period. Number one, as I mentioned earlier, it is one of those tools that do not consider the value of time value of money. Okay, so even though the cash flows are in the future, we do not count the future cash flows. Okay, we treat the cash flows as they are, but we know for a fact that discounting or interest is also has an impact, okay, on the value of your money. Number two, it ignores the cash flow after the payback period. Now recall that when we have computed the payback period, we're done. We will present that to management. Okay, the payback period is this and that. Whether it's acceptable or not to management is another thing. Okay, but we do not consider anymore the cash flows after we have reached the payback period. Okay, because what we only want to know is when do we recover our investment. Okay, so that's the only thing we want to know for the payback period. That's why we do not consider the cash flows after. And of course, number three, it ignores project profitability. Okay, it might be easy, but when it comes to project profitability, it totally ignores the profitability of the project because what we're after is really the annual cash return. Okay, so that's a payback period. Now, accounting rate of return, on the other hand, is a second tool for Group 1. The accounting rate of return is used to measure the annual earnings. So that's actually the book earnings of the investment that the investment is expected to make. It calculates how much money or return an investor will make on his investment. So essentially, accounting rate of return or book return, because it is based on the net income of the project. If you use the formula, that's investment income divided by investment cost. It's the investment income, that's how much is the income of your investment. Okay, so let's have an example again using the example earlier. So here we have computed the net after tax, sorry, this after tax of 1,750,000. So your accounting rate of return is 1,750,000 divided by 10 million or 17.5. So this is your accounting rate of return. Now, is this acceptable or not? Now, as I mentioned, we have to compare this with the cost of capital. Now, in this case, the cost of capital that we use is 6%. 6%, but I think it's 6%. So when we compare this to the 6%, this is more than 6%. So therefore, this is more considered for acceptance by management. Okay, so that is your accounting rate of return, but it only uses the book return or the book income. Okay, next. Okay, this is what I said earlier. This is compared to the hurdle rate or cost of capital. If this is more than, then the project is likely can be accepted. Okay, next. The group two are those that consider the time value of money. So we have the discounted payback, the net present value, and of course the profitability index. Now for the discounted payback, the concept is essentially the same, but now we just have to, since I mentioned earlier, those are future values, we just have to discount the future values. Okay. Now for the discounted back, now if you would, do your time. So the today is day of investment. You will have to spend 10 million, and these are your um, future annual cash returns for the next 5 years. Okay, so this is what we use. Let us assume that the cash flows are uniform. So if you look at your timeline, okay, so you have 3.5 end of first year, 3.5 end of second year, and so on and so forth. So these are all future values, which you are comparing with your cost, and the cost is what value today. So for it to be compared like apples with apples, like apples and orange compare, you say it's not comparable. Of course, it's not. Okay. So for it to be comparable, we discount this 3.7 million that is supposed to be received in future using the discount rate. Okay. So if we do that, we'll end here. So 6% present. So again, I've already taught you how to get the present value factor. If you forget about, if you forgot it, then just have to go back to the time value of money video which I posted last. Okay, so this is the present value factor, and then multiply the annual cash return with the present value factor for year one, you get the present value factor of the ACR. Same is true with the rest. So just discount all of this with this present value factors, then you get the present value of annual cash return. Now again, since the values are not the same, we cannot make use of our simple formula earlier. So what we will do is we will accumulate the annual cash return. So if we accumulate on year one, your annual cash return is 3.5, and that is also the accumulated annual cash return. Now, going to year two, so the year two present value of annual cash return is 3.3. So 3.5 plus 3.3, you get 6.8. Now, again, this is less than the 10 million investment. So therefore, you have 2 years, but the cash flow is still short than the 10 million investment. So we go to year three, which is 3.1 million. Now, if say 6.8 plus 3.1, then it's already 10 million. 10 million 23, which is 23,000 of our investment cost. So the payback period is still between 2 to 3 years, but uh, it's gearing towards year three because this is only 23,000. So what we'll do, we will again get the difference. Let's see if I have it here. Not okay. So what we'll do is we will get the difference. So that's yun. That's the cost of investment minus the cash flow, the accumulated annual cash flow of 6,874,500. So we will be needing 3,125,500. If we divide this by the present value of annual cash return on year three, that's 248,500, then we'll get almost all of it. So 99, that's 0.99. So therefore, our payback discounted payback period, okay, for this project is 2.99 years, almost 3 years. Okay, so this is the first um, tool that uses the time value of money. Number two is the net present value. So net present value is a difference between the present value of the future cash flows and the cost of investment. Okay. Now, so here, so you get the present value of future cash flows and then compare that with the cost of investment. Because as what I said, if you discount the future cash flows, then the values are reflective of the present value, okay, which you now compare with the cost of investment because that is also at its present value. So comparison of compare to investment, you have the net present value. Now, if the present value of future cash flows is higher than the cost of investment, then this becomes positive. And the decision rule is if this is positive, then the project is acceptable. Okay? So if this is a positive NPV, then the project is acceptable. Let's again go to our example. So in our example, if you would let's go back. So here the present value of the future cash flows is 15,795,000. Okay, so let's okay, here 15,795,000. Compare that with the cost of investment, then we have a net present value of sorry, then you have a net present value of 5,795,000. So again, if we will take this 5.7 million as the net present value, then the project is likely to be reduced. Okay. Now it means that a cost of our investment. Yeah, I mean the benefit is really than what we have put in as a okay. Now profitability index, the second one, it is actually um, it is actually the ratio between your present value of the future cash and the future investment. So in order to decide whether the project is acceptable or not, we have to check the profitability index. If it's greater than 1, then it indicates that the project is a good investment. Okay, if it's more than 1, if it's less than 1, then it's not a good investment to pursue. It will not bring additional value to the company. Okay, so let's again have the figure. So present value future cash flows at 15,795 divided by 10 million, that's 158%. So this is more than 1. Okay, that's almost 1.5. So the thing is, this be considered for acceptance by management. So far we've discussed two. That is the net present value and the profitability index. The third one is the internal rate of return. So this IRR, or the internal rate of return. So this is the discount rate that makes the net present value equal to zero. Okay. Now remember, the present future cash flows we discount, right? And then we compare that with the cost of investment. So this internal rate of return is the discount rate that if you use that, the net present value becomes zero. So it means that this is the actual rate of return that the project is really earning. Okay, yun. So this is the internal rate of return. Now this is a bit more challenging than the others, as I mentioned, because here for the internal rate of return, we have no choice but to use the trial and error. Okay, and if ever we cannot locate, the exact internal rate of return, then we have no choice but to interpolate. I hope that you still know how to interpolate. Okay, so let's have an example. So here is that we will be using the present value of annuity. Okay, now remember our time frame is 5 years. So looking at this. Okay, so which of this? Okay, from 4% to 50%. Let's check. So how are we going to do that? As I mentioned earlier, in the trial and error. Number one is our starting point. We can make use of the payback period. Okay, we have computed earlier as our starting point. So if we go back, so this is the payback period 0.6666 and the stuff. Okay, now what we will do is we will locate 2.66667 input of annuity under 5 years. So if we go back, so this is 5 years, and then we are looking for 2.666. So if you would notice, it is between here, 25 and 26, 2.666. So this is between this two. Okay, but going to towards 25, I guess. Okay, so but that is not exact. Okay, so what we will do is we will interpolate. We will take these two, 25 and 26, present value factors. Okay, so if we go, if we would look at, if we will interpolate, sorry. So we have, this is the one that we're looking for. So that's 2.6. 25% present value factor of an annuity is 2.6, and then 26 is 2.635. Okay, so it's between. So the difference, the difference here is 1%, and then we can take this, that's 2.6 minus 2.666, that's 0.02224, and then 2.6, and then this one minus this one, you have the negative 0.54. Okay, so let us interpret. So we will actually take this one, so 1%, we will take the ratio and proportion. Okay, so 1% multiplied by 0.0224 divided by 0.054. This is actually the ratio and proportion. Okay? So what we will have, 1%, and 0.4 here is actually, yeah, 0.0224 divided by 0.05. Okay, so this is your ratio. Okay, so therefore, that's going to be 25% plus 0.4148 or 25.4148. So this is your exact internal rate of return. So if the discount, if the hurdle rate is 6% and the project is 25%, then this project is really it's a go for the company because the earning is really higher than the uh, of capital. Okay, and to prove that this is really the internal rate of return, we will discount all cash flows, okay, by the present value factor using into the rate that we got here, which is 25.448. So again, if you calculate the present factor of an annuity for this one, I suggest that you go back to the previous video I posted. Okay. Um, so if we discount, what we will have is 9,198,625. Compare that with 10 million investment. So still not zero, but that is just because of the present value factor, because we cut the will not cut the decimal, then this will be very, very little. So therefore, the internal rate of return really for this project is that's 25.41%, which is again more than the discount rate or the cost of capital. And this project might be accepted by management, okay, as it will bring good fortune and it will bring wealth to the company. Okay, so if you have questions, I hope that you were able to get something from this discussion. Or there's an airplane. Uh, and I'd like to thank you for watching this video. I hope I will see you again in my other videos, which I will post in the near future. Okay, so if you have questions, then just write in the comment section, and I'll try to get back to them. Okay, thank you very much. Bye.